Let's get into it. So you've done your home fund, and I can see here on the shared document that you looked into improving the Sharpe ratio for SPY and gold and a combination of that. And you think the Sharpe ratio is actually a little bit better than before, correct?
Yes.
Let me see. So you've already done the work. So all I do is I'll just check it. So let's just check the Sharpe ratios for the individual instruments and see what we get. So we've got gold 0.54, SPY 0.44. Okay, so that's our gold standard, so to speak. All right, so now what we want to do is basically see if we get something better. So what we're trying to do here is basically see if we can improve the overall Sharpe ratio by having a portfolio of gold and SPY together. And what we want, or what the homework was for Josh, was to basically go and put a portfolio of two assets together such the Sharpe ratio is larger than any of the individual assets. So that's what we're doing. And what we're having here is SPY, the S&P 500 ETF, and gold futures. So there is a bit more wizardry to gold futures. It doesn't quite work just like taking the prices in a sense. But what I told him is, at the moment, we just assume that whatever we see as the price of gold futures is just simply the price. So we don't worry much about that for now. Okay, so let's just do this. Let's see if we can get the Sharpe ratio of the two. So, Josh, question to you. What do we need to do here to get the Sharpe ratio of both? So what we want is an equally weighted portfolio of the two instruments. And what we have is two columns with the price, with the returns, and we want to make an equally weighted portfolio out of them.
Yeah, we need to put them together in a way that they're like starting from the same point, and then like going through the percentage changes in that way.
That's true, but that's not even the important part. The important part is, if we want to have an equally weighted portfolio of several columns, right, what we need to do is we need to take the average across the rows, right? So each return that we have at each single date, we need to take the average. And that basically tells us, oh, we're weighting them equally, because you know what an average really is, or a simple average is just, you know, an equally weighted adding up of all the parts, okay? So that's just what it is. So what we do is we go mean, and then what we do is we need to average it across the rows. So we say x is equals 1, okay? And we need to do this twice because we have the returns here. Actually, before we get the Sharpe ratio, let's have another look what the combined portfolio will look like. So what we do is we do the cumulative sum and we plot it. And then we should see our combined portfolio. There we go. So that's what our combined portfolio looks like. We could also plot the individual ones there as well. So what I often do is, when I do this, I'll do something like alpha equals 0.5, and so that makes the lines a bit transparent. I make the line widths of the other one, of the important one, a bit bigger, like let's say like this. And so this is just, oh, look, actually, sometimes this happens when we plot, it actually plotted it in two, and sometimes when we reverse the order, it actually plots it in one plot. There you go. See, so this is effectively our two portfolios, and they look quite different, right? And the resulting portfolio clearly has less volatility, you know, has got a good performance and so on. So we can see that, they definitely help each other to some extent. All right, so let's just see what the Sharpe ratio is. And we've got 0.68. Well, that's significantly better than both of them. Well done. Excellent. All right, so homework done successfully. Great. Now the big question is, 6.8, not too bad. Can we do even better than that?